Every day, before most of the world wakes, a narrow strip of water no wider than a distant horizon line carries the lifeblood of the global economy. This is the Strait of Hormuz, a slender maritime corridor carved between the rugged southern coast of Iran to the north and the mountainous Musandam Peninsula of Oman to the south. It links the enclosed waters of the Persian Gulf to the Gulf of Oman, which then opens into the vast Arabian Sea and the wider Indian Ocean beyond. On a map, it appears almost insignificant, a thin blue thread between two brown landmasses. In reality, it is one of the most strategically vital waterways on Earth. At its narrowest navigable point, the strait measures only about 34 kilometers across. Within that space lie two designated shipping lanes, each just a few kilometers wide, guiding vessels in opposite directions. The margin separating inbound and outbound traffic is minimal. Massive oil tankers, some stretching longer than 3 football fields, pass each other here with only limited room to spare. And through this confined passage flows an extraordinary volume of energy. On any given day, more than 20 million barrels of crude oil, condensate, and refined petroleum products move through these waters. That represents roughly 1/5 of global daily oil consumption. In practical terms, nearly every 5th barrel burned in a car engine, refined into jet fuel, or used to power industrial machinery has crossed this narrow channel. No overland route exists that can replicate this capacity at comparable scale. Pipelines connect certain Gulf producers to alternative export terminals, but their throughput is limited and cannot compensate for a full maritime disruption. Rail transport is insufficient. Overland trucking is economically unrealistic. The geography of the region makes large-scale redirection of energy flows slow and structurally constrained. For decades, the Strait of Hormuz has functioned as the primary artery of global hydrocarbon trade. Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, Qatar, and Iran all depend on it to move their exports outward to international markets. From here, tankers sail eastward toward China, India, Japan, and South Korea, nations whose manufacturing output and energy consumption rely heavily on steady supply from the Gulf. The route also feeds European markets, either directly or indirectly, shaping fuel prices across the continent. This is not simply a shipping lane. It is an economic circulatory system. Oil from these waters fuels aircraft crossing continents. It powers container ships transporting goods between hemispheres. It heats homes in winter. It drives heavy industry. It stabilizes national budgets in exporting states and underpins growth in importing economies. And yet,
Despite its scale of influence, the strait's geography remains remarkably fragile. The surrounding terrain is harsh and imposing. To the north, Iran's coastline rises in dry, rocky formations. To the south, Oman's Musandam Peninsula presents steep cliffs plunging into deep blue waters. The confined geography creates natural choke points where naval monitoring is straightforward and maneuverability is limited. The strait's strategic importance was recognized long before the modern oil era. Historically, it served as a gateway for maritime trade between the Middle East, South Asia, and East Africa. But in the 20th century, as oil emerged as the dominant global energy source, Hormuz transformed from a regional corridor into a global fulcrum. With that transformation came tension. The strait lies at the intersection of competing national interests, military calculations, and geopolitical rivalries. Iran occupies the northern shore and controls several islands within or near the channel. Oman governs the southern approaches. Both countries hold territorial waters extending into the strait, meaning that vessels transiting the channel pass through zones under national jurisdiction. Under international maritime law, specifically the United Nations Convention on the Law of the Sea, the Strait of Hormuz qualifies as an international transit passage. Ships are legally permitted to move continuously and expeditiously through the strait without obstruction. But legality does not eliminate leverage. Over the past several decades, Iran has periodically signaled that it could restrict or close the strait in response to external pressure, sanctions, or military threats. Statements from political leaders and the Islamic Revolutionary Guard Corps have reinforced the perception that the strait represents a strategic bargaining tool. These warnings are not casual rhetoric. They are calculated reminders of geographic reality. Because when a waterway carries 1/5 of global oil supply, even the suggestion of disruption sends ripples through energy markets. Traders monitor developments closely. Naval forces from multiple countries maintain presence in surrounding waters. Insurance premiums fluctuate with political headlines. Oman, by contrast, has often positioned itself as a stabilizing mediator, maintaining open communication channels with both regional and Western powers. Its approach has traditionally favored continuity of passage and diplomatic balance. The coexistence of these positions creates a delicate equilibrium. The Strait of Hormuz operates not merely on law, but on restraint. Every tanker that moves through its waters does so under an unspoken understanding that despite rivalry, despite sanctions, despite tension, the global cost of closure remains extraordinarily high. Yet that cost is precisely what gives the strait its power. It is narrow enough to be influenced. Vital enough to matter. And sensitive enough that the world watches it constantly. This is the anatomy of the world's most important energy corridor: confined waters, towering stakes, and a geopolitical fault line beneath the surface. And as long as the global economy depends on oil, the Strait of Hormuz will remain not just a passage, but a pressure point.
If Iran were to attempt a blockade or serious restriction of the Strait of Hormuz, the consequences would not unfold gradually. They would arrive in waves, immediate, financial, strategic, and psychological. The first signal would not be missiles or explosions. It would be hesitation. Tankers waiting outside the Gulf would delay entry. Shipping companies would request updated risk assessments. Insurance underwriters in London and Singapore would revise war risk premiums within hours. Freight rates would spike before any physical closure was fully confirmed. Because in global energy markets, perception moves faster than ships. Nearly 20 million barrels of oil and petroleum products move through the strait each day. That flow feeds refineries across Asia, Europe, and beyond. It supplies jet fuel for airlines, diesel for logistics networks, and petrochemicals for manufacturing chains that stretch across continents. When that flow appears threatened, markets react instantly. Oil futures would surge as traders price in disruption.
We are seeing a sharp spike.
Brent crude could climb sharply in the opening hours of uncertainty.
Disruptions in key regions, global markets.
Analysts have long warned that a sustained blockade could push prices well beyond $110 per barrel, possibly far higher in a panic-driven spike. Energy markets are highly sensitive not only to actual shortages, but to anticipated ones. Even a temporary slowdown in tanker traffic could trigger speculative buying, amplifying volatility. Financial markets would follow. Stock indices in energy importing nations could dip. Currencies tied to oil imports might weaken. Inflation expectations would rise. The shock would not remain confined to trading floors. For major importers, the stakes are structural. China sources a significant share of its crude imports from Gulf producers whose exports pass through Hormuz. India's rapidly expanding economy depends heavily on Gulf energy. Japan and South Korea, industrial economies with limited domestic energy resources, rely on maritime imports for stability. An abrupt disruption would ripple into fuel prices at home. Transportation costs would increase.
manufacturing margins would compress. Central banks might face renewed inflationary pressure just as they attempt to stabilize growth. Europe, too, would feel the strain.
An update on a serious national matter. Our assessments
Governments
are
would
ongoing.
respond
We are committed to
quickly.
Transparency and public safety. We will brief you as more details are confirmed.
Strategic petroleum reserves would be opened to calm markets. The United States maintains one of the world's largest emergency crude stockpiles. Japan, South Korea, and members of the European Union also hold reserves designed specifically for supply shocks. But reserves are finite. They are a bridge, not a replacement. Meanwhile, global shipping logistics would begin to shift. Some tankers might reroute or delay loading. Others would proceed under naval escort if tensions escalated further. Insurance costs could multiply several times over, raising the delivered cost of oil, even if supply eventually resumed. And then there is the military dimension. The United States Fifth Fleet, headquartered in Bahrain, has long maintained operational readiness to protect commercial transit through the Gulf. American destroyers, surveillance aircraft, and mine countermeasure vessels regularly patrol these waters. Allied naval forces from the United Kingdom and France maintain regional presence as well. In recent years, multinational maritime security initiatives have coordinated patrols to ensure freedom of navigation. A sustained attempt to restrict passage would likely trigger expanded escort operations and visible naval deployments. The risk of miscalculation would rise. Even a minor maritime incident, a warning shot, a collision, a drone encounter, could escalate tensions rapidly in such a confined environment. Yet Iran would face its own dilemma. Approximately 80% of its foreign trade passes through ports connected to the Persian Gulf. Oil exports remain a critical source of revenue. A prolonged blockade would restrict Iran's own commercial throughput, intensify domestic economic strain, and potentially undermine political stability. This is the central paradox of the Strait of Hormuz. It is both shield and vulnerability. The threat of closure provides leverage in moments of geopolitical confrontation, particularly in response to sanctions or military pressure. But actually executing a long-term closure would impose significant costs on Iran itself. That balance explains why, despite repeated warnings over decades, a full sustained blockade has never materialized. Instead, tension often manifests in calibrated signals, naval exercises, maritime inspections, temporary seizures, rhetorical escalation. Each episode tests the boundary between pressure and provocation. But the margin for error remains thin. In a global economy still deeply intertwined with hydrocarbon flows, the mere possibility of disruption alters behavior. Corporations hedge risk, governments diversify suppliers, energy importing nations accelerate investments in alternative routes and renewable sources. Yet, even with diversification efforts, the Strait of Hormuz remains unmatched in scale. And that is why the world reacts so sharply to any threat involving it. Because when a corridor this narrow carries consequences this wide, uncertainty itself becomes destabilizing. In the next stage of the story, the focus shifts beyond immediate economics. Because a crisis in Hormuz would not only raise oil prices, it would reshape alliances, harden military postures, and test the fragile architecture of global interdependence. And that transformation could endure long after the ships begin moving again.
The Strait of Hormuz is not merely a passage for oil. It is a pressure point in the architecture of global power. For decades, this narrow channel has sat at the intersection of energy dependence, military deterrence, regional rivalry, and national pride. Its waters reflect a larger story, one in which geography shapes strategy, and strategy shapes history. If a serious crisis were to erupt here, the consequences would extend far beyond fuel prices. They would reshape political calculations across continents. At its core, the Strait of Hormuz represents leverage. For Iran, positioned along the northern coastline, proximity translates into influence. Control of coastal radar systems, naval assets, fast attack craft, anti-ship missile batteries, and drone capabilities gives Tehran the ability to project power into the narrow shipping lanes. Even without a formal declaration of closure, increased patrols, inspections, or military exercises can alter risk perception. In geopolitical terms, influence over Hormuz acts as a counterweight. When faced with sanctions, diplomatic isolation, or military pressure, the ability to threaten disruption of 1/5 of the world's oil supply becomes a strategic bargaining chip. It signals that pressure applied to Iran can produce consequences beyond its borders. But leverage cuts both ways. A prolonged disruption would almost certainly trigger an international response. The United States, whose Fifth Fleet operates from Bahrain, has long defined freedom of navigation in the Gulf as a core interest. Naval doctrine and decades of presence in the region are built around ensuring uninterrupted commercial transit. A direct attempt to seal the strait would likely draw not only American involvement, but broader coalition coordination. The United Kingdom and France maintain capable naval forces in the region. Regional partners such as Saudi Arabia and the United Arab Emirates would push for rapid stabilization. Even China, heavily dependent on Gulf oil imports, would face pressure to diplomatically engage to protect its economic interests. The strait, in such a scenario, would become the focal point of a global strategic standoff. And in confined waters, standoffs are dangerous. The geography leaves little room for maneuver. Naval vessels operate in close proximity. Commercial tankers move slowly and are vulnerable. The risk of miscalculation rises sharply when political tensions intersect with crowded sea lanes.
History offers reminders. During the 1980s tanker war phase of the Iran-Iraq conflict, commercial vessels were targeted, prompting international escort operations. Even limited maritime incidents created outsized geopolitical reactions. In a modern crisis, the stakes would be even higher. Energy markets today are deeply integrated with financial systems. A shock in Hormuz would reverberate through currency markets, sovereign debt pricing, insurance sectors, and equity exchanges. Emerging economies dependent on energy imports could experience currency depreciation and capital flight. Export-dependent Gulf states could see budget projections destabilized. But beyond economics lies something even more profound: strategic realignment. A major disruption could accelerate shifts already underway in global energy policy. Importing nations might intensify investment in renewable energy, nuclear power, and diversified supply chains to reduce exposure to choke points. Pipeline infrastructure bypassing Hormuz could receive new urgency. Maritime security coalitions could deepen. At the same time, regional alliances could harden. Gulf Cooperation Council states might strengthen collective defense integration. Iran could draw closer to strategic partners willing to challenge Western naval dominance. Diplomatic channels would operate at full capacity, attempting to prevent escalation while preserving national interests. The strait would transform from a shipping lane into a symbol, a test of how interconnected the modern world truly is. Because the global economy today is built on assumptions of continuity. Ships move. Trade flows. Energy arrives. A disruption in Hormuz would expose how fragile those assumptions can be. And yet, there is a paradox embedded in this vulnerability. The very fact that so many nations depend on the strait creates a shared incentive to prevent catastrophe. Exporters need revenue. Importers need supply. Naval powers seek stability. Even adversaries recognize that total closure would produce unpredictable and potentially uncontrollable consequences. In that sense, the Strait of Hormuz operates as a mutual constraint. Its importance deters the very crisis it makes possible. But deterrence is not certainty. Political miscalculation, regional escalation, or unintended incidents can override rational cost-benefit analysis. In high-tension environments, symbolism and domestic politics sometimes drive decisions as much as economic logic. That is why global observers watch the strait so closely. Satellite imagery monitors vessel movement. Energy traders track tanker departures. Intelligence agencies analyze naval exercises. Headlines shift markets within minutes. Because in this narrow corridor, the local and the global converge. A patrol boat maneuver in confined waters can influence fuel prices thousands of miles away. A diplomatic statement can move billions of dollars in market value. Few places on Earth compress such vast consequences into such limited space. Today, ships continue to pass through the Strait of Hormuz. Oil flows. Markets stabilize. The global system functions. But beneath the surface lies constant calculation by governments, militaries, traders, and corporations. The strait remains open not by accident, but by balance. A balance of deterrence. A balance of necessity. A balance of risk. And as long as the world remains tied to hydrocarbon energy, this narrow gateway between Iran and Oman will remain one of the most sensitive fault lines in international politics. A channel only 34 kilometers wide. Yet wide enough to shape the fate of nations. When tankers glide silently across its waters, they carry more than oil. They carry the weight of global stability. And in that fragile passage, the world's future sails every single day.